Morning.
First, congratulations on the very strong numbers. Let's begin with China, which contributed in a strong way to your performance. Do you see China contributing even more going forward in the coming quarters?
Well, we certainly hope that will be the case, but it's not a given that it can be done just like that. The team on the ground have to work very hard. What we would expect for the coming quarters is really for operating PATMI or operating performance to remain fairly robust and fairly stable. And we believe that with the opening of our new reference city in Shenzhen, Hangzhou, as well as in Shanghai, as well as the opening of our capital mall in Wuhan, we expect this to contribute towards operating performance in the next few quarters.
So pretty upbeat. When you take a look at China, it accounts for 43% of your assets in your portfolio. Are you comfortable with that? Are you looking to grow it? What's the percentage that you'll be okay with going forward?
I think we are comfortable with the 43%. We are even comfortable if it should go up to 50% or slightly above 50%. Given the size of China market, China is a very big market. It is currently the number 2, the world second largest economy in the world. Is in the near future it will be the largest economy in the world. So from that perspective, having about 50% say of the capital deployed in the world largest market, I think it's something that we are comfortable with.
But why bet big on China when there's so many risks? I mean, we're talking about a government that's trying to cool down the property sector. We have rising debt, financial risks. Why are you so optimistic about this property market?
Well, first of all, this is a big market, and China is at a stage where we still expect to see relatively high economic growth. Currently is at about 6.7%. The projection is that for the full year is likely to be somewhere in the region of 6.8 or 6.9%. So this is a very strong performance from the GDP perspective. And given that this is a very strong performance, there will always be demand for real estate, especially when you have the urbanization concurrently taking place in China.
So risk-reward, you see that it's worth taking the risk.
Yes, I think the risk-reward of the opportunities in China justifies for us to put in the capital to invest in some of these projects. There are some risks involved, but as in all investments, there will be risks involved, but the risk-reward that we see in China justifies this. On top of that, I think we have a very strong team on the ground that can help to mitigate many of these risks.
I want to touch on Singapore, 35%, 35% of your assets right now. When you take a look at property prices, they've been on a decline for 15 consecutive quarters, but some upside in the last quarter. Just a slight decrease of 0.07%. You call it stable. Is that a sign of a turnaround in the Singapore property market?
Okay. I think if you look at the statistics, there are a lot more transactions happening in the last quarter compared to, say, a year ago. And if you look at the price decline, it has sort of slowed down. We used to have much bigger decline on a quarter-on-quarter basis, but in the last quarter, as you just mentioned, the decline has been much smaller. So there's a sign that there is a sort of a bottoming out in the Singapore residential space. We look at the market and we look at fundamentals of the market. I think the fundamentals has not shifted very much. What has really changed is that for many of the investors who now put their capital or put their money into real estate, in residential real estate in Singapore, a lot of this is driven by the relative attractiveness versus a few other markets like Hong Kong, London, or some of the Australian market. The barrier to entry or the transaction cost in some of these markets are even higher.
You talked about how prices may be bottoming out, but do you see a rebound in Q3? And is that sustainable going forward? Because when you take a look at the trend, any rebound has been pretty inconsistent.
Yes. I think for a rebound to take place in a more sustainable basis, there has to be overall improvements in the fundamentals. Right now, it's very much still liquidity driven. So from that perspective, which is why the Monetary Authority of Singapore came out and mentioned that they are unlikely to relax the current tightening measures.
So you see no further relaxation of the measures? I mean, we saw the government ease some of those measures for the first time in 8 years.
They make some adjustment. They make some adjustment to to two of the, specifically to the seller stamp duty and also to the TDSR concerning certain group of property owners. But those are really minor adjustments that they make to in a way, to remove certain distortions that the current cooling measures have on the market. So having done that, I think the latest pronouncement from, or latest announcement that MAS commented on was that they are unlikely to relax the policy this year, or the timing is not right, the condition is not right for the relaxation.
But we have seen transaction volumes going up. Could that lead to further tightening instead?
Well, I believe that the current measures that we have in place are already very stringent policy. So unlikely to see further tightening, but at the same time, given the current market conditions, it's unlikely that we will see a relaxation, certainly not within this year.
Mr. Lim, just one final question. The luxury property market has been badly hit. It's been hit the most. Prices have come down 15 to 30%. Have prices bottomed for the luxury property market? Do you see a turnaround? Do you see property prices coming up now?
Generally, as a market, I do not see a strong pickup, but I would say that there are pockets of opportunities that individual buyers have gone in and they have picked up certain properties which potentially may give them some upside.